Hello, this is Squanray Invest. Today I'll be talking about why big tech is in trouble. So, your big tech companies are down massively this year. You have Google that's down around 25% from all-time highs. You have Meta down around 20%, Amazon down around 21%, and Microsoft down around 18%. So there's a few narratives that is floating around right now for all your different big tech companies. The first narrative is that the AI capex is in excess and it will lead to a lot of depreciation and the returns won't be as good as expected. The next one is the high valuation and the growth forecast dropping. And then the last one is just the tariff concerns. So let's talk about the tariff concerns first. So if you're to compare the tariff in 2018 versus currently in 2025, in 2018, we have a much more robust economy. So as you can see over here, GDP was at around 3 to 4%, inflation was low at around 2%. Interest rates were also low at 2.5%, and unemployment was at a historical low at 3.7%. And currently, the economic conditions are not as strong as back then. So GDP is now only 2%, inflation is at 3%, we have higher interest rate as well, and then unemployment is higher as well. So in this current economic environment, the economic conditions are a lot tighter, it's not as strong as back then. So if we continue with all these different tariffs, if Trump actually go and implement all his different tariffs, then we could see a lot more negative impact as compared to 2018, rightly so, because in 2018, the economy was a lot more robust as compared to now. So as you can see over here, the Atlanta Fed GDP, they basically forecasted again, and then they forecast downwards. So now even the goal adjusted one is in a negative GDP growth category already. And if you have 2 quarters of negative GDP growth, that is a recession already. So if we have another quarter, Q2, of negative growth as well, then we are in a recession officially. But for this one over here, as you can see, the economy is clearly weakening, and if Trump basically continues with all his different tariff concerns and all that, then we could see a lot more downside in this economy. Next one is the overvaluation. So even after this 10% crash or so, the stock market is still overvalued. We're still currently trading at around a 27 times earnings. That is a lot higher than the average of around 25 times over the past 10 years. And the low point, which is where I call the fair value, is around a 20 times. So I would like for the stock market to go to around the 20 times. That would be around the fair value price for the stock market. And currently 27 times is still overvalued for this market. So the first narrative that the most important narrative for all these different tech companies is that the capex is skyrocketing. So as you can see over here, the capex is just mooning. They increased their capex by 50% in 2024, and they're expected to increase it even more in 2025, which is this year as well. They're planning to spend upwards of $300 billion on capex. And if you were to draw comparisons to the dot-com bubble, this is actually similar to all your different telecom companies that spend a lot on capex to try and increase their bandwidth of their telecom services. So back in 1999 and the 2000 year, all these different telecom companies, they basically just built infrastructure, built a lot of different telecom services so that they can basically create a new internet and then improve on all the different telecom services that they had back then as well. So we are seeing something that is extremely similar to back then, where all these companies, they spend a lot of money, incremental amounts of money that could lead to no returns. So your capex over here, what they use the capex for is mainly for your data center. So it'll be for your LLM as well as your cloud computing. And the big tech companies, specifically your Google, so Sundar Pichai, he basically said in the last quarter that currently demand is greater than supply. And so they're trying to ramp up the capacity so that they can meet the demand for this one. So the problem with capex is capex will lead to a lot of depreciation. So depreciation from high capex. So for example, let's say Amazon spends $100 billion this year, and let's say the data center chips last for around 5 years. So let's say 80% of the depreciation basically happens over the next 5 years. That is 16 billion a year in depreciation already. So that is currently double of the depreciation that they're having every single year. So Amazon currently in 2024, they had a depreciation of around 15 billion. And if let's say this whole scenario happens over here, they're doubling that depreciation over the next 5 years as well. So for Amazon over here, the net income currently is around 59 billion. They're projected to grow about 20% in earnings. But if the capex has no ROI, then the earnings growth is zero because your depreciation will basically cover up all the different earnings from other different segments that Amazon has. And the most important metric for the next quarter to look out for all these different hyperscalers is your ROIC. If the ROIC slumps, then there could be a big problem there, meaning to say that the AI capex spending, it is not producing enough returns for shareholders. It is not producing enough tangible returns. So your capex is hurting your free cash flow as well. So free cash flow is a metric that Warren Buffett uses. It is your owner's earnings. So your free cash flow is your operating cash flow minus your capex. And when your capex increases, what happens is your free cash flow will drop, meaning to say less money can be used to basically return to shareholders. So for all your different big tech companies, your free cash flow is projected to drop this year. It dropped last year as well. And next year, then we could see a recovery after that when the capex growth slows down. But generally, you want your free cash flow to rise for all your different big tech companies, even for all your different other companies as well. So, is the capex necessary? So, DeepSeek showed us that a lot could be done with a lot less. So, they were using the H100 chips, which is far less superior as compared to all your different more advanced chips that all your Amazon, your Google, your Microsoft is ordering from NVIDIA. So maybe the capex now is a lot more than what is needed to produce the same ROI, and your capex will eat into cash flow, which means that there'll be less money for buybacks, less money for dividends, and less EPS growth for all these different companies. So what you're seeing now in terms of the EPS growth may be a lot inflated, a lot more inflated as compared to what could happen in the future, because your capex depreciation will lead to less earnings, which will hurt your EPS in the future. It won't hurt it now because it'll be spread out over a few years, but it could hurt it in the next few years or so. So for your capex, the winners of capex is the distributors and the providers. So the way I see it is, like, let's say you have a railroad, the railroads don't win. The companies that use the railroads will win. So it's similar to the telecom bubble back in the year 2000, where your telecom companies didn't win. Your social media companies that use the telecom services, that leveraged on all these different cheap telecom services, they won. Because all the telecom services company, they're just building for nothing. They're building in hopes of there'll be demand for the future, but they don't have pricing power. Basically, it is commoditized at this point. So an argument is that all your different hyperscalers, they're building out their cloud infrastructure. The cloud infrastructure could be commoditized in the future, which is not what we want. So even though I have all these different bearish theses in front, why am I still bullish on all these different companies? So all these different cloud companies, all these different hyperscalers, they are their biggest customer. They use their own products. So you have, for example, let's say Azure and Microsoft 365. Microsoft 365 is heavily dependent on Azure. You have Amazon as well, Amazon Retail, your Amazon Online Retail, Amazon third-party seller services, subscription and all that, and advertising as well. So all of those is dependent on AWS as well. And then you have Google Cloud Platforms, which is working for your Google, YouTube, your search, and your subscription as well. So this is a lot different from your telecom companies back in the year 2000, because all your different telecom companies in the year 2000, what they did was they just built a lot of telecom infrastructure without actual demand for it, because they don't have their own companies that is using their own product. They're just building in hopes of maybe creating 4G, 5G, and so on. But for all these different hyperscalers over here, they have their own other businesses that will use their product. So there won't be as much of a problem as compared to your telecom companies back in the year 2000. So as you can see, AWS was profitable even before generative AI came out in the year 2022 and 2023 when ChatGPT came out. So I expect them to continue with this secular growth trend. So as you can see over here, 2013 to around 2021, they basically 20x their AWS revenue, and I expect them to continue doing so over the next few years. And AWS is not completely dependent on generative AI, on AI infrastructure and all that as well, because over the years from 2013 to 2021, they basically just skyrocket, and then they just continue growing and growing and growing and growing. So it's more predictable as compared to companies like Nvidia. Nvidia, they basically skyrocketed in 2022. They don't have a history of growth. But for companies like Amazon, for Azure, they're a lot more resilient as compared to Nvidia's data center revenue. So for all these different hyperscalers over here, they have a diversified income stream. So for example, let's say Google, you have search, YouTube, services, subscription, and cloud is only about 5% of the net income. So if cloud fails, then it doesn't really affect the core business of Google, because the core business of Google is still now in search. You have Amazon as well with your retail subscription, third-party seller, and then your advertising as well. And if all these different segments can improve their margins, then Amazon's stock will go up a lot. And then you have Microsoft over here with Microsoft 365 and personal computing as well. All these different businesses, they are outside of your cloud computing. So your AI capex will be used to benefit their own business as well. So for example, let's say you have Amazon, AI can be used to basically improve efficiency and for all your different portions of Amazon's business. So you have your retail business, you can have robots and all that, and then you can improve efficiency and improve margins on those business. And overall, all this AI capex, basically, even if there is overcapacity, all these different companies, they can use that overcapacity to go and improve their current existing business, not so much the cloud itself. And then you have Google as well, which can improve ROI on advertising, as well as Waymo. Waymo requires AI infrastructure as well. And then you have Meta, which can improve efficiency of advertising, as we saw last year where they grew EPS by about 50% year on year. So the durability of this business are just unmatched. So this is Microsoft's earnings, Microsoft's revenue over the past few years, and you can see it's been just up and up and up and up and up. Because these are all durable quality businesses. They won't be affected by maybe a short 1 or 2 years economic downturn. So Nvidia over here is the one I'm bearish about because they had explosive growth in the past 2 years, and I'm not too sure if they have enough diversified streams to basically diversify out of the AI data center revenue. Whereas for all your different other hyperscalers like your Google, your Meta, your Amazon, Microsoft, all these different businesses, they're very diversified. They have other revenue streams outside of the AI revenue that they're getting right now, and they can improve efficiency on top of just building the cloud. So for all the different valuations over here, I don't think it's extremely demanding right now. So you have Microsoft at 31 times, Amazon at 34 times, Google at 19 times, and then Meta at 23 times as well. So the valuation is really not demanding for all these different companies. Of course, it could go down a lot more. It can go down to around 25 times for each one of them, maybe 25 times for Microsoft, 25 times for Amazon, maybe 15 times for Google, and 15 times for Meta. But for all these different companies over here, I think the valuation right now justifies the quality of the business. They're not extremely undervalued yet, apart from Google, but I believe that it is a decent buying opportunity right now for all these different companies. So my verdict for this is that overbuilding could be dangerous, but no one knows. But for now, we either have 4 tech CEOs that are basically pushing for success, or they're just 4 idiots. So for me, my bias leans towards the former because I mean they have been able to produce all this different earnings growth, all this different success for the past few years already. So I don't see them trying to basically boost their ego and like just basically go and build into all this capex AI capex spending for nothing. So the returns may not be as large as we were told to believe, but a lot of these companies are not dependent on AI entirely.